Hello, everyone, and welcome. This is your Money Show host speaking. My name is Charlotte. I am just waiting here for Peter Thomas to join me in the Zoom room, and then hopefully we will get started on time. Now, I know that Peter lives in one of the areas that's being hit pretty hard by all of those snowstorms coming through. So we're just going to give him a few minutes here, make sure that he has good connection and everything. I will keep you all updated. Thank you for joining us, and thank you for your patience. For anyone just joining us, hello and welcome. This is your Money Show host. We are just waiting for Peter Thomas to join us in the Zoom room, and then we'll go ahead and get started. The session time for this one is 2:10 p.m. to 2:40 p.m. That's Eastern Time. Thank you all for your patience. All right, everyone. I'm just going to give Peter another minute or two here to join us. And don't worry, if he does not make it, I do have another session that I can play for you here today, and I will update the platform to reflect that. But once again, just going to give Peter a couple more minutes to see if he is able to join. For those of you who were not here a little earlier, Peter does live in an area that's been hit pretty hard by these winter storms. And so we just want to give him some time to log in, just in case he was maybe having some power trouble. With that said, thank you all so much for your patience, and we'll be getting started shortly regardless. Okay, everyone. As I said, just giving Peter a couple minutes here. I do think that I'm going to go ahead and play a different session for you all. I do apologize for anyone who's looking forward to seeing Peter live. We'll do our best to reschedule him, hopefully tomorrow, depending on what we hear back regarding his power issues and things like that. But that being said, if you'll just give me a moment, I will get set up here and I'm going to go ahead and play you a different session that I'm sure everyone will still enjoy. Okay, everyone, thank you all for your patience. Now, if you are watching us live and you go ahead and refresh your page, you will now see a new title with a new speaker for this session time. As I told those of you who've been waiting in the chat with me here, I have not heard from Peter. We do believe that he may have a power outage due to some winter storms. So I'm going to go ahead and play you another session that I have with me here from Irene Aldridge. We're very much looking forward to this. And with that said, I am going to go ahead and get started. This session is Predicting Performances of Black Box Systems. Hello, everyone, and welcome. Thank you so much for your patience. Joining us for this session is Irene Aldridge, a recognized quantitative researcher, fund manager, and CEO of two startups. She's also an adjunct professor at the Cornell Financial Engineering in Manhattan program and the Cambridge University Masters in Finance program, or Judge Business School. She has previously successfully brought two platforms to the market, Able Alpha and Able Markets, both in the financial services space. Now, to our live viewers, please feel free to share any questions, comments, concerns, anything like that in the chat box. It's on the right-hand side of the video player, and time permitting, we'll see if we can get to some of those at the end. With that all said, Irene, I will hand the mic on over to you.
Thank you. Awesome. Thank you. Thanks, everyone. It's a pleasure to be here. Hope everybody's doing okay today. Have you seen the Bitcoin and the Ethereum? Oh my God, that's such a bloodbath, right? So the question is like, could we have predicted that this could have occurred or in anywhere? How can we design and assess or evaluate any kind of platform for predicting future returns really, really quickly? All right. So, and this is something I've been working on for a very, very long time. And I have been, I worked in banking, I worked on trading floor, I worked in quantitative research. I led the risk management team in the opposite order. So I started in risk management. I led the long quantification team. And then I moved into research. I did equity research and ETF research. And then I moved into trading in foreign exchange. And from there, I designed a bunch of high frequency trading strategies, and I founded my own high frequency trading proprietary trading shop. So, and I did that for a few years. And a client of ours came to buy our data, and that's how we moved into the alternative data space. And we were very successful there for about 10 years until AI kind of came along, and everybody has decided that they now can reverse engineer everything they can that possibly comes to their hands. So our margins collapsed. So now I'm back managing money in the fund, and we're up on track for 40% up this year. We're up 1% today. So we're doing very, very well, and that's in large part thanks to all the research I have been doing over the years. And we're open, by the way, for investment so please reach out to me by Gmail or Irene@ablemarkets.com. I've also written a bunch of books over the years. So one of my later books is Big Data Science and Finance. It's right here. It's published by Wiley. It's available on Amazon, and it basically covers machine learning strategies across the board. So everything you want that I really, really like it's in here. Okay, it's a little technical, but I'm sure a lot of you guys really like technical stuff. Not like technical analysis stuff, but like wanted the technical. Anyway, so the purpose of today's talk is this is focused on my latest research. And my latest research is, it really arose from my clients' questions. When I was selling them my predictive data, they would say, well, how would we know this data would work out of sample? Meaning, once you put the data, the tires to the road, will it work? Like what kind of guarantees do you have that what you're selling us is actually going to work tomorrow? And it's a very good question. And it took me really a long time to think about it. It's like, how do I guarantee performance of systems? How does anybody guarantee performance of systems? And most importantly, how does anybody do this really, really quickly without like investing months and months of statistical testing, which is what Citadel does now, right? So if you try to sell Citadel data, they're going to spend months. Just the quants are going to analyze it and look at it from various directions, and it's just too expensive. That's very, very time consuming, and let's try to do it faster. Okay. So of course, today we have algorithms used everywhere, not just in trading, but like everywhere you name it: transportation, communication, healthcare, disaster management. So everywhere you go. Okay, and this is what our algorithms look like now. Okay, so they're extremely complicated. We have some raw events or some data that's being pumped into the system, which has like numerous stages, which has these convolutional neural networks, some other neural networks, deep neural networks, long short-term memory neural networks. We have all sorts of stuff, and not to mention different language models and everything, transformers, et cetera, et cetera. Like, there are not enough acronyms in the English language to really describe the complexity of the AI models that we're just now facing. So how do you ascertain that this thing is going to work, right? So this is really the purpose of the talk. But even if the model is very, very simple, even if it's just a basic linear regression that you're using to predict future returns, how do you know it's going to work out of sample? And this is what I have been working on. So most solutions are highly sensitive to tuning. Tuning means parameterization. Like every time you fix some number inside your model, let's say the relationship is going to be, most often they call them betas, right? So as soon as you fix this beta, that's basically you're tuning your model. And you never know what's going to happen tomorrow because you tuned beta on today's and yesterday's data. So how do you know what's going to happen tomorrow? Okay, so I have a working paper on this. It's on SSRN. If you go to ssrn.com, there are lots of papers that are free. Okay, so this paper is called "Predicting Performance of Black Box Systems," and so this is what I'm going to describe today. So before we go there are some existing solutions for AI management. Now, all of them are pretty complicated. Okay, so this is just two of them. This is sensitivity analysis and parametric optimization, that they're basically considered to be one of the best. All right, so basically these guys, what they said, they're going to basically do an approximation of your function, of your predictive function. And you can have a global approximation and a local approximation, and that's something we kind of can do as well, right? So basically the idea here is you can linearize any kind of function, right? So you can just use your linear regression and linearize, like if you have some very complicated AI thing, you can just use inputs and outputs and draw a straight line through them. And that's something we're going to be using to that extent as well. right? But that approach was very difficult for people to understand. So let's say another approach that people have been using, it's like this is an AI system that helps doctors who observe the symptoms to explain to their patients and to accurately diagnose their patients with AI. Okay, so the doctor looks at the patient and says, okay, the patient is sneezing, he has a headache, but he's not tired. So, and the doctor enters these things into the AI system, and the AI system gives a diagnosis. Okay, so, but how does the doctor know that the diagnosis is correct? Well, this is the same model, right? So this is applied to actually explaining what's in the picture. Okay, so we have a picture of a dog playing a guitar, and how do you explain it to the person that this is a correct interpretation? Well, you show pieces of the picture. Okay, so you show a guitar and you show a dog, and therefore this is a dog playing a guitar. Okay, so it's one component at a time, and that's a bit of a challenge with that model, but this is one way of doing things. It's a very popular way. Okay, so when you have multiple components, this is a very complicated model to explain multiple components at the same time. But this is just another way of doing things. Okay, so I like to do everything super simple, right? So if we have super simple, we have a bunch of variables, whatever they may be, some predictors, they may be costs, they may be returns, whatever data you have, and you put it through this black box. And the black box is your complicated system that gives you some optimal decisions about what to invest in. Okay, so that you can make money tomorrow. And it doesn't necessarily just have applies to stocks, right? It can apply to everything, but here we're talking about trading and financial applications. So consider the output of this model portfolio weights. Okay, so if portfolio weight is 1, then you put all your money and you put it into that one stock. If portfolio weight is 0, you do not invest into that particular stock or whatever, right? And if it's anything in between, then you put a little bit here, a little bit there, just as the model suggests. Okay, so the higher the weight that's produced by this black box, the more money you put into that particular financial asset. Okay, so that's our setup. And how are we going to measure this performance? We're going to compute a loss function. All right. So, and the loss function is very common now in machine learning. So, and the way we calculate loss is we take realized total, okay, minus predicted total. So we don't know what the prices are going to be tomorrow. All right. So we want to we want to buy something today, right? But tomorrow we want our prices to go up. All right. So our best prediction today of the cost tomorrow is today's prices, right? So today's prices is our best prediction of prices tomorrow. So and then we don't know what the prices are going to be tomorrow, right? But they're going to be something, and they're not necessarily going to be today's prices. They're also going to be dependent. Our total cost is going to be dependent on our portfolio composition. So how much money we invest into each asset is going to give us a different different understanding or different kind of realization of how much money we're going to get. So anyway, so the important part here is we're measuring loss, and the loss is going to be realized total cost, like realized total amount of money, how much we have money tomorrow, minus how much we predict we're going to have money tomorrow. Okay, so we're trying to do the best we can today to maximize the money tomorrow and to structure our portfolio in such a way that we predict tomorrow as good as possible, as best we can possibly predict it. And so we're going to take, and then we're going to measure this loss, realized minus predict. Okay, so, and this is known as suboptimality loss. It's pretty standard now in machine learning literature. And what we basically take, we take the realized tomorrow, our realized value of our portfolio, and subtract the predicted value of our portfolio that we expect today. So that's E0, it's expected today, okay, expectation today on today's day 0. And that C is the vector of costs. In our case, it's actually returns. Okay, so and pi is our optimal decision, or at the bottom we have a better notation. It's W is our vector of optimal portfolio weights. Okay, and R is our returns. So we have loss, which is realized returns minus expected returns. And basically, this is my key contribution. I mean, there are lots of people that have been studying this over many, many years, okay? And very, very recently too, and in top journals, there are articles that say that this expected loss is zero, okay? So we always expect loss is zero. And what I show, it's not zero, okay? This expected loss of a black box model is never zero. It's actually covariance, and it's covariance between your returns and the portfolio allocation weights. Okay, so but that's what we're doing here. We're taking returns and portfolio allocation weights, and we're taking covariance between these two, and it's going to be our realized loss. Okay, expected loss, sorry, expected loss of our model. That's it. It's very, very simple. Okay, and the intuition here is, again, we're linearizing linearizing our model, okay, and we're taking covariance is how much does our prediction and our weights move together, and if we apply it to real data, okay, so let's say we have 5 stocks, okay, and we're going to run a simulation. We're just going to simulate different means and different standard deviations. The only assumption we're making is that these returns are stationary, meaning means and standard deviations stay put over time. They don't change dramatically. So this is how our returns look like. Okay, and this is our optimal weights. We determine using a Markowitz model. Okay, so the standard Markowitz portfolio optimization. So the more data we have, the more stable our weights are as we move to the right. Right, we sample more and more times. We get pretty stable observations. And this is our loss function that we were just computing. It's kind of all over the place. So we average it with the green line. So you can see the green line dips at the beginning, and then it kind of goes up into zero. So fine. So what I'm saying is with my covariance model, okay, that I just showed you, covariance of inputs and outputs, we can predict this expected loss right away. So we don't have to accumulate lots of observations and see how the model is going to perform while we're accumulating these observations. This covariance, this what I'm saying is this loss is always going to converge to the covariance between inputs and outputs. Okay, it's pretty crazy. It's very, very simple. No one has done it before. So basically we can save a lot of time and a lot of money if you have any kind of complicated system. You take inputs, which is your predictors, output, in our case, portfolio weights, and you compute the covariance of the two. Okay, and the covariance is going to be your loss, expected loss of the system. That's what how much on average your system is going to miss the mark. Okay, so this is and this, you can compare different systems on the basis of how much they're going to miss the mark. Some systems are going to miss the mark by more than expected basis, right? Some systems are going to miss the mark by less. So you want to select more accurate systems. We want to be this loss to be as close to zero as possible. So you want covariance between inputs and outputs to be as close to zero as possible, and that what's going to give you the optimal prediction. Now, what's the intuition behind it? Well, just like in the linear regression, your linear regression is best when your explanatory variables are orthogonal. Okay, orthogonal not just to each other, but also to the output. So or the errors are orthogonal to the predictors. So this is what we're aiming for. We're aiming for completely orthogonal predictors, and that's going to generate you this zero covariance between inputs and outputs, and that's going to be your optimal loss. Okay, so so these are portfolio weights. This is what they look like over time. This is our loss. This is our expected loss versus realized loss. We actually, in this case, we actually underestimated. Okay, our realized profit. It's actually greater than we thought it would be. Okay, so which is even better. But the bottom line is there's lots of related literature that they can talk to more about this. But this is a real very something very different about how to predict the losses. Okay, and here's just another example with real stocks. Okay, so just 5 stocks selected for no particular reason, just to illustrate this point. And what we have here is this is different rolling means of returns and different rolling standard deviations of returns, right? And this is our suboptimality loss. Okay, so on the left we have a realized loss, and oh, this is actually average realized loss. Okay, so we're just averaging what we see there. But here is our predicted loss versus average realized loss, and as you can see, on the simulated data, it's actually converges very closely. On the real data, it does not converge all that super closely. Okay, and that's because we have non-stationary data. Okay, so our data here moves all the time, up and down, and so the best thing we can do, we can continuously re-estimate this loss. So we can run like a window within which we can assume that our data is stationary, so the means and standard deviations stay constant over time. And in that case, on the right, you have our predicted versus realized loss, and you can see they're now very close together. So when we take a shorter estimation window instead of estimating over the entire sample, but like in this case, we're estimating over a quarter, over 60 days, then this model indeed predicts for future looking performance very well. How well our model that we're using is going to predict the returns over over the next 60 days. Okay, so this covariance between inputs and outputs, it's a very simple idea, and what it does, it allows you to estimate the loss of any predicted model ahead of time. Okay, so again, we want this loss to be 0 because that's the most accurate model if there's no loss whatsoever, and when our expectation equals our reality, and this covariance delivers us the estimate of how closely we can expect on average to have the realized versus predicted values to be. Okay, so that's what this is about. All right, so this is we're calibrating expected loss versus realized loss. Again, this is over real data. So as you can see, we're tracking it very closely over time. And the other thing I wanted to show you is so there are different implications. So we can predict again the value of these any kind of predictive system ahead of time. But one other thing, I was just running these experiments to show you something very cool. So I'm going to switch my window here and show you some interesting things that I have just been building this morning, specifically to show you for what's going on. Okay, so let's see. I have some interesting results. I hope it's interesting for you. Okay, so let's say we're taking a bunch of prices. So Bitcoin is and Ethereum is interesting. So this is monthly data. Okay, and monthly it's slightly delayed, right? So I don't know if you can see the screen. Hold on a second.
So I do see the monthly prices chart on your screen right now.
Perfect.
Yes.
Okay, great. Thank you. Okay, so this is the chart of monthly prices. Okay, again, this is the Bitcoin and Ethereum and the S&P 500 and a couple of ETFs. One is Bitcoin ETF, one is Ethereum ETF. Oh, I can make it larger. Okay, good. So let's say like this. Okay, so Bitcoin, of course, has been growing like crazy. I think this is monthly data ends somewhere in September. That's why we don't see this latest bloodbath that we're experiencing now. Okay, so the question is it possible to predict Bitcoin and Ethereum with the S&P 500 or vice versa? like, what should we do? What should we invest in? What's the practical implication of this all this modeling that I just showed you? And so let's look at the returns first. Okay, so we want to predict returns, not prices, always. Okay, and the reason we want to predict returns and not prices is because prices are closer to the normal distribution, or returns, sorry, and are closer to the normal distribution than prices are. And most of our models are based on the assumption that the data follows normal distribution, right? So quantitative models. Okay, so here are the returns. Okay, so S&P 500 has been around since 1991. So it's a green line. It's been going up and down. Then we have Bitcoin come online. Bitcoin went down, and Bitcoin went up. And then we have Ethereum with these huge orange spikes. And most recently, we have a Bitcoin ETF, the red line, and Ethereum ETF, the purple line. Okay, so all of these pretty curious instruments. And let's see if we can actually make sense of what we're doing. So what we're going to do, what I'm going to do is I'm going to try to establish, can we predict, let's say, can we predict Ethereum with S&P 500? Okay, so, and this is, I'll show you a simple chart right now. So this chart is, okay, so this chart, oops, sorry, nope, that's not it. Here's this chart. Here's this chart. Okay, so this chart is, we have S&P 500, and on the y-axis, we have next month Ethereum. Okay, next month Ethereum, S&P 500, next month Ethereum. Okay, so it's just a scatter plot. These are returns. There's no like clear definitive relationship or anything along those lines, but just for your information, what it looks like, right? And let's say we try now something different. Maybe we try predicting today's this month's Ethereum, and we're trying to predict S&P 500 in months from now. Okay, so this is kind of different. So we're using now, we're using Ethereum, and if Ethereum goes up today, maybe we want to see if S&P 500 goes up next month. Okay, and this is what the chart looks like here. Also, kind of maybe there's some relationship, not clear. So if we run this covariance model that I just showed you, we can very easily immediately tell which prediction is most accurate. And I have a bunch of code I'd like to show you. This is the code, okay? So sorry, I don't like usually to show code, but I figured everybody is writing code now these days. So what I'm doing here is I open these files, I computed the returns, and all I'm doing now is right here, I'm calculating the covariance between what I think may be the predictors versus what the output will be. So the first one, I am printing, okay, I'm going to calculate and print covariance between lag Ethereum and SPY. Okay, so this is going to be my first one, and that's what I'm going to show you. Okay, the next one is, so this would be to measure if this month Ethereum went up, how accurately can we predict S&P 500 going up next month? The next one is if S&P 500 went up this month, how accurately can I predict Ethereum going next month, up next month? So let's see, this is going to be Ethereum. Okay, and then we'll do the same with Bitcoin. And we're going to do the same with, so we're going to do lag Bitcoin. So this is lag Bitcoin, and we're trying to predict S&P 500. Okay, and then it's going to be lag Bitcoin, and we're trying to predict Ethereum. So lag Bitcoin, and we're going to predict Ethereum. And finally, we're going to have lag S&P 500. So it's S&P 500 now, and we're going to predict Bitcoin. Okay, so I'm going to run this code that I have here, and let's see what we're going to get. I've run it a few times, so but still, ta-da-da-da. Okay, so this is one of the charts I already showed you, but let's look at the code. Okay, so, and here's the code. Look at that. So covariance of lagged Ethereum and SPY is our expected loss is about 7 basis points or 7% of a percent. Okay, maybe close to 8, maybe almost 8% per percent, right? So if we look, so that's if we use Ethereum this month, Ethereum return to predict the future S&P 500 return, we can expect at least 8 basis points. On average, we can expect 8 basis points. We're going to be 8 basis points off. Okay, so meaning if whatever the prediction model you have using Ethereum and then translating it into the S&P 500, it doesn't matter what your prediction model is. Okay, really, because you're always going to have this. Well, it's not true that it doesn't matter what kind of model you have, but if you're just trying to convert from Ethereum to S&P 500, on average, you'll be off by 8 basis points, which is not so bad. But then if you're trying to use S&P 500 to predict Ethereum, so if this month's S&P 500 went up, you would expect next month's S&P Ethereum to go up. You actually have a much smaller loss. Okay, so your covariance is now only 1 basis point, right? So this model is a lot more accurate, meaning when the S&P 500 goes up, maybe people are feeling better and looking for alternative investments. And that's when they go and put money into Ethereum. Okay. When the Ethereum goes up, people don't just take the money out of Ethereum and put it into the S&P 500. Like we have a much bigger error there. We have much bigger loss versus when S&P 500 goes up, people do take the money and put it into Ethereum at that point, the next month. Okay. The next month. So, and this is our smallest loss model. Okay. So we also have, if we have Bitcoin, and we're trying to predict the S&P 500 1 month ahead, we have a much bigger loss of 13 basis points. And if we have Bitcoin and trying to predict Ethereum the following months, we have a loss of 67 basis points on average, right? And so, and then if we're trying to use S&P 500 to predict Bitcoin, we still have, it's a negative loss, but it's still a loss. And we're counting it. We really are looking at the absolute value here, not at the at the magnitude, not the sign thing. So, and here we're again back to 8 basis points, basically the same as using last month's Ethereum to predict this month's S&P 500. So bottom line is out of these simple, very simple basic models that we've considered here, the best performing one we can pinpoint right away, very, very simple. And it's going to be that this month Ethereum has a chance of predicting this month's S&P 500 return. It has a chance of predicting Ethereum returns next month. Okay. So as the markets expand, as things are getting better, people chance it or have been chancing it and sticking some money onto Ethereum. And this has been out of all the other models that we just considered here in this very, very simple example, that has been the best performing thing so far. Okay, but we can similarly calculate like what goes on with Apple or with Nvidia and with any one of your favorite stocks. It's very, very easy to do. Again, it's just this covariance relationship, and it gives you expected loss. Okay, so if you have different models, you can pick right away the one that has a lower expected loss, and that's going to be the one that has a lower covariance between inputs and outputs. Okay, so that is all I wanted to share with you. I think I'm right on time, and I would love to answer any questions if there are any questions. And thank you so much for participating and for listening.
Okay? Fabulous. Thank you, Irene. I do have one quick question for you before we sign off here. Eddie had asked about Bitcoin and Ethereum. Would you sell now? They're dropping like crazy, he says.
Well, so I do a lot of research on Bitcoin and Ethereum. I can talk about this for hours, okay? So, and the fundamental thing is, just like Bitcoin and Ethereum, they have, for the longest time, they were considered to be as potential replacements for the financial system, right? But what my research shows that ever since the ETFs became a thing, okay, ETFs for Bitcoin and Ethereum, that instead of investing directly into Bitcoin and Bitcoin and Ethereum, most people started investing into the ETFs. Okay, so because ETFs offer some protections in the markets and it's a more established asset class, so investors stopped really investing so much into the Bitcoin and Ethereum per se, right? They stopped opening accounts, they stopped trading as much, they started trading ETFs. And also in the background, the existing financial markets have not been sleeping. Okay, so they look at all the innovations that are going on in Bitcoin and Ethereum, and they're taking them over. Like JP Morgan has been building their own blockchain that they're already having production, and last year they were moving $1 billion on that blockchain every day. Okay, so and they're basically taking the best innovations that have come up on Ethereum or Bitcoin, and they're incorporating them into their own platform, and they're innovating on top of that, right? So it's there. Nothing is stable per se, and as a result of all of this, so the usage for Bitcoin and Ethereum is not clear. You know how the stocks are always valued, like Apple, for example, is valued based on what are its growth prospects. You know, how many people are going to use the phones? Is it a good phone? Like, is it popular? Similarly, Nvidia, like how many chips are they going to produce? Who is going to buy them? Are they going to grow in their chip production? Right. So in the same way, Ethereum and Bitcoin and all the other coins, they became like stocks in a sense, right? So there are these technology companies, and the question is, well, are people going to use their technology, or they're going to build their own, use like basically take the technology over and build their own? And right now the question, it's not clear, right? So it seems like traditional finance has already taken over a lot of Bitcoin and Ethereum innovation, and then incorporated it into their traditional markets. So that's where I think the biggest problem is, that there is no like use case for Bitcoin and Ethereum as such, right? It's not like it's a revolutionary platform that everybody wants to switch to, because it's not the case. One other issue. So, for example, the whole thing was built around the idea that there are going to be no broker dealers, and as a result, there are going to be really low fees, right? And it's going to be such a democratic environment. And guess what? The fees are super high if you want to trade Bitcoin or Ethereum. And now they're realizing that people don't want to display their private transaction information. So now there used to be no broker dealers, right? That was the big thing about Bitcoin. But now they're coming up with broker dealers. You know, there are these automated, they call them roll-ups. Okay, so I have a paper on that too. And these roll-ups are essentially broker dealers. Okay, so they're cryptographic broker dealers that prevent the markets from discovering the identity of people who are trading. And this is where it becomes kind of a blurry area. So is this really what the intent was of these blockchains, or are we just moving towards traditional finance because traditional financial systems are the dominant market design, right? And yes, we're using a little bit of cryptography to make everything automated and 24/7, and it's a big advantage. I'm not disputing that, and that's going to persist, right? But my point is, like, companies like JP Morgan, they already have that. They've already built it inside their models, and although they're not publicly trading in them, or they're not publicly available for use, they're still kind of in the testing stage, but they have been working for the last 5 years at least. So the question is it really, it's a Bitcoin and Ethereum really going to stand out as these Apples of the world and Nvidias that everybody will want to flock to and use them as their data? And I think that's why we see what we see today in the markets, because right now the answer is not clear. So it's not at all clear that there is a need in financial services for what Bitcoin and Ethereum has to offer. It's not clear that Ethereum, even though there's so many people invested so much money in it, it's not clear that it's making much progress. So that's the challenge.
All right. Well, Irene, thank you so much for
Thank
joining
you.
us today. So glad that we could get in a little bit of, Q&A conversation with the audience there at the end. It's been a pleasure having you on to present, and I know that our audience appreciates all the information that you've shared with us.
Thank you so much, Howard. I really appreciate it.
Absolutely.
Thanks, everybody.
And to those of you watching us live, be sure to stay tuned. We do have a couple more sessions coming up for you in this Money Show Virtual Expo. But as always, I hope everyone has a wonderful rest of your